The silver-gold ratio just hit 88 to 1. The last 3 times this level was reached, silver didn't drift higher slowly. It exploded. March 2020. Ratio peaked at 90. Silver tripled in 11 months. January 2016. Ratio hit 83. Silver gained 67% in 7 months. October 2008. Ratio touched 84. Silver doubled in 9 months. This isn't prediction. It's pattern recognition. And the pattern says that when gold becomes this expensive relative to silver, the reversion is violent, fast, and mathematically inevitable. The ratio doesn't care about narratives. It cares about extremes. And we just hit one. Let me explain what the silver-gold ratio actually measures, because most people see the number and don't understand what it's telling them. The ratio answers a simple question. How many ounces of silver does it take to buy 1 ounce of gold? At 88 to 1, you need 88 ounces of silver to purchase a single ounce of gold. That's the exchange rate between the two metals. And like any exchange rate, it oscillates around a long-term mean. The historical average over the past century sits somewhere between 50 and 70, depending on which period you examine and how you weight the data. We're currently 30 to 50% above that range. That deviation isn't random noise. It's a signal that one of 2 things is happening. Either gold is significantly overvalued relative to silver, or silver is significantly undervalued relative to gold. The math doesn't care which narrative you prefer. The outcome is the same. Here's why this matters more than most technical indicators. The silver-gold ratio is one of the oldest continuously tracked metrics in commodity markets. It has hundreds of years of data behind it, and throughout that entire history, extreme ratios don't persist. They mean revert. Sometimes the reversion happens through gold falling, sometimes through silver rising. Most often, it's a combination where silver rises faster than gold, compressing the ratio back toward historical norms. The key insight is that the ratio itself creates its own reversion mechanism. When silver becomes extremely cheap relative to gold, participants start substituting. Industrial users explore whether they can use silver instead of other metals. Investors rotate out of gold and into silver to capture relative value. Speculators position for mean reversion. All of that behavior creates buying pressure on silver that has nothing to do with silver's fundamentals and everything to do with the ratio being stretched. That's the setup we have right now. And the historical precedent is clear enough that ignoring it requires either ignorance of the data or a belief that this time is fundamentally different. Let me walk through the 3 most recent examples in detail, because the pattern is remarkably consistent. March 2020, the ratio spiked to 90 as gold surged during the initial COVID panic while silver crashed along with everything else. Silver bottomed at $12. Over the next 11 months, it rallied to nearly $29. That's a 140% gain. Gold gained 25% during the same period. The ratio compressed from 90 to 65, not because gold collapsed, but because silver significantly outperformed. January 2016. The ratio hit 83 after years of silver underperformance. Silver was trading at $13.50. By July 2016, it had rallied to $21, 67% gain in 7 months. Gold also rallied during this period, but silver's outperformance compressed the ratio from 83 to 66. Again, the mechanism was relative performance, not absolute collapse. October 2008, financial crisis. The ratio touched 84 as silver crashed to $9 while gold held relatively firm. Over the next 9 months, silver doubled to $18. Gold rallied as well, but the ratio compressed to 58 because silver moved faster. Same pattern, same mechanism, different fundamental environment. 3 separate economic contexts, 3 different starting prices, same ratio extreme, same compression pattern, same relative outperformance window of 7 to 11 months. That consistency is what makes this setup so compelling. It's not dependent on a single catalyst or a specific macroeconomic backdrop. It's dependent on the mathematical inevitability that extreme deviations from historical means don't persist indefinitely. Now let me address the obvious objection. What if this time is different? What if structural changes in the market have altered the ratio dynamics permanently? It's a reasonable question. And the answer is that every time the ratio hits these levels, people make exactly that argument. In 2020, they said central bank money printing had made gold permanently more valuable than silver. In 2016, they said industrial silver demand was dead and it would never recover. In 2008, they said the financial system was ending and monetary metals would decouple from industrial ones. All of those narratives had elements of truth, and all of them failed to prevent mean reversion. Why? Because the ratio isn't just a measure of relative value. It's a self-reinforcing mechanism. The more extreme it gets, the more participants have incentive to lean against it. And markets are full of participants who understand this dynamic and position accordingly when the opportunity presents itself. Here's what makes the current setup particularly interesting. We're not just at an extreme ratio. We're at an extreme ratio, while silver fundamentals are arguably stronger than they've been in decades. Industrial demand is accelerating due to electrification and solar deployment. Investment demand is rising as inflation concerns persist. Supply is constrained by permitting delays and underinvestment during the previous bear market. None of that is priced into a ratio of 88 to 1. This creates a situation where the ratio suggests silver is historically cheap relative to gold, and the fundamental suggests silver may be cheap on an absolute basis as well. That's asymmetry. The setup doesn't require believing in a massive silver bull market. It just requires believing that 88 ounces of silver should not trade for 1 ounce of gold when the historical range is 50 to 70. Let me be clear about what I'm not saying. I'm not saying silver will definitely triple from here. I'm not saying the move will happen in exactly 11 months. I'm not saying everyone should panic buy silver at any price. Historical patterns establish probability, not certainty, but probability matters. And when a historically reliable signal reaches an extreme level, the probability distribution shifts significantly in favor of mean reversion. The risk-reward becomes compelling not because of what you think will happen, but because of what has happened every time this setup has appeared. If the ratio stays elevated or goes higher, silver doesn't need to crash for you to be wrong. It just needs to underperform. But if the ratio compresses even partially back toward historical norms, silver will likely outperform significantly regardless of what gold does. That's the trade. You're not betting on silver's absolute direction. You're betting on relative performance. And relative performance during ratio extremes has been consistent enough over multiple cycles that dismissing it requires assuming something fundamental has changed about how these markets interact. Maybe it has, but the burden of proof is on that assumption, not on the pattern that has worked repeatedly. Now, let me address timing, because this is where most people get tripped up. The ratio can stay extreme longer than you expect. It can go higher before it reverts. 88 to 1 could become 95 to 1 before compression begins. That's entirely possible. And if you're positioned with leverage or short-term options, that variability can be painful. But here's the critical insight from the historical data. Once the ratio starts compressing, the bulk of the move happens in the first 4 to 6 months. The pattern isn't a slow grind over years, it's a relatively sharp adjustment over months. That means the cost of being early is time and opportunity cost. The cost of being late is missing most of the move. This is why the setup rewards positioning over prediction. You don't need to call the exact bottom of the ratio or the exact turning point in silver's price. You need to be positioned before the move begins, accept that timing is uncertain, and allow the pattern time to play out. Trying to time the perfect entry usually means missing the move entirely. Let me walk through what the compression could look like under different scenarios. Scenario 1, gold consolidates while silver rallies. This is the 2020 pattern. Gold held a relatively tight range while silver exploded higher. The ratio compressed primarily through silver's outperformance. If this happens again, a move from 88 to 65 would require silver to gain roughly 35% if gold stays flat. Scenario 2, both metals rally, but silver rallies faster. This is the 2016 pattern. Gold gained 20%, while silver gained 67%. The ratio compressed because of relative performance, not because gold collapsed. If this plays out, you get upside in both metals, but significantly more in silver. Scenario 3, gold corrects while silver holds or rises modestly. This is less common, but has happened during certain periods. The ratio compresses because gold comes down rather than silver going up. This is the worst case scenario for precious metals bulls, but still results in ratio compression. The point is that all 3 scenarios compress the ratio. Only the mechanism differs. And from a positioning standpoint, being long silver or long the silver-gold ratio benefits in all 3 cases. That's the asymmetry. You're not dependent on a single outcome. You're dependent on a pattern that can manifest through multiple paths. Now let me address the practical question. How do you actually trade this? There are several approaches, and the right one depends on your risk tolerance, time horizon, and account structure. The simplest approach is just buying physical silver or silver ETFs and holding through the compression. This requires the least sophistication and the lowest maintenance. You're purely betting on mean reversion over a 12-month window. The more sophisticated approach is a pairs trade, long silver, short gold, in equal dollar amounts. This isolates the ratio itself and removes directional exposure to precious metals as an asset class. If both metals fall but silver falls less, you profit. If both rise but silver rises more, you profit. You're purely capturing the spread compression. This requires margin and active management, but offers cleaner expression of the thesis. Another option is using options to define risk. Buying silver calls with 6 to 12-month expiration gives you leveraged upside while capping downside at the premium paid. This works well if you believe compression will happen, but don't want unlimited downside if you're wrong about timing. The trade-off is that options decay over time, so if the move takes longer than expected, you lose money, even if direction is eventually correct. Each approach has merits. The key is matching the strategy to the thesis. If you believe the ratio will compress but don't want to predict when, physical or ETFs make sense. If you believe compression is imminent and want leverage, options make sense. If you want to isolate the ratio and don't care about precious metals direction, the pairs trade makes sense. Regardless of approach, the historical precedent is clear. 88 to 1 is an extreme. Extremes don't persist indefinitely. And when they compress, silver outperforms gold. That's the pattern. That's the setup. The question is whether you position before it moves or after everyone else has already recognized it. Here's why most people will miss this opportunity, even though the data is public and the pattern is well documented. First, the setup requires patience. The ratio could stay elevated for weeks or even months before compression begins. Most traders can't handle uncertainty that long. They need immediate confirmation or they exit. Second, the setup requires ignoring short-term noise. Silver is volatile. It will have down days and down weeks, even if the intermediate trend is up. People who can't stomach that volatility will get shaken out before the move completes. Third, the setup requires believing in patterns over narratives. Right now, narratives favor gold. Central banks are buying gold. Investors see gold as the safe haven. Silver is viewed as the industrial metal that underperforms during uncertainty. All of those narratives have some truth. But the ratio doesn't care about narratives. It cares about math. And the math says 88 to 1 is unsustainable based on centuries of data. Betting against that requires believing current conditions are so different from all previous periods that historical patterns no longer apply. Maybe they don't, but that's a very high bar to clear. Let me also address the failure scenario because understanding downside is as important as understanding upside. What would invalidate this setup? The ratio moving significantly higher and staying there for multiple years. If we go to 95 or 100 and remain elevated for 2 or 3 years, that would suggest something structural has changed. At that point, the pattern would be broken and the thesis would need reassessment. But even in that scenario, the setup isn't catastrophic if you're positioned correctly. If you own physical silver and the ratio goes higher, you haven't lost money unless silver's absolute price falls. If you're in a pairs trade, you lose on the spread, but the loss is defined and manageable. If you're in options, your loss is capped at premium paid. The worst case is painful, but not devastating. Compare that to the upside. If compression happens as it has the previous 3 times, the return is substantial. 60 to 140% gains in 7 to 11 months. That's the kind of return that justifies taking the risk of being wrong. And the risk reward becomes even more compelling when you consider that the pattern has worked 3 times in a row across completely different market environments. This is the essence of probabilistic thinking. You don't need certainty, you need favorable odds. And when a historically reliable pattern reaches an extreme, the odds shift meaningfully in favor of positioning before the move rather than waiting for confirmation. Confirmation is expensive. It usually shows up after the easy money has been made. Now, let me address a more subtle point that most analysis overlooks. The silver-gold ratio isn't just a technical indicator. It's a reflection of how market participants perceive risk, utility, and value across 2 related but distinct assets. When the ratio is extremely high, it's telling you that the market values gold's monetary premium far more than silver's industrial utility and secondary monetary function. That perception can persist for a while, but it can't persist indefinitely because silver's industrial utility doesn't disappear just because the market isn't paying attention to it. And when perception eventually corrects to reality, price adjusts rapidly. The ratio extremes are therefore not just about mean reversion. They're about perception extremes that become unsustainable once industrial demand reasserts itself. This is happening right now. Solar panel production is accelerating, electric vehicle penetration is growing, semiconductor demand is recovering. All of these trends require silver, and they don't care that the silver-gold ratio is 88 to 1. They need the metal regardless of how it's priced relative to gold. That creates the fundamental tension that eventually forces the ratio to compress. Here's the final piece that ties this together. The ratio setup doesn't exist in isolation. It's occurring alongside several other factors that reinforce the thesis. Refining capacity is maxed out. Mine supply is constrained. China is restricting exports. Investment demand is rising. Industrial demand is accelerating. None of these factors care about the gold ratio, but all of them support silver's absolute price. And when absolute price support meets relative value opportunity, the setup becomes exponentially stronger. This is why dismissing the ratio as just a technical indicator misses the point. Yes, it's a ratio, but it's a ratio that reflects hundreds of years of accumulated trading behavior, industrial usage patterns, and monetary perceptions. Like when it reaches extremes, it's not random. It's signaling that something is mispriced. And mispricings don't last forever in markets with active participants and clear historical patterns. The silver-gold ratio hitting 88 to 1 is not a guarantee of immediate returns. It's a probability distribution shifting meaningfully in favor of compression. The last 3 times this happened, silver outperformed dramatically within 12 months. That doesn't mean it will definitely happen again, but it means the odds are favorable enough that ignoring the setup requires either unfamiliarity with the data or belief that this time is fundamentally different for reasons that override centuries of mean reversion behavior. You can wait for confirmation. You can wait for the ratio to start compressing before you position. But understand that confirmation is expensive. The move happens fast, 4 to 6 months for the bulk of it, and by the time it's obvious to everyone, you're buying after the ratio has already moved from 88 to 75 and wondering why you didn't act when the setup was clearer. That's the trade. That's the pattern. That's the historical precedent. 88 to 1 doesn't stay 88 to 1. It compresses. And when it does, silver outperforms. The only questions are timing and magnitude, but those questions exist in every trade. What doesn't exist in most trades is a pattern this consistent across this many cycles. When you get that combination, the setup deserves serious attention regardless of what current narratives suggest.